I am pleased to be joined today by Julian Melling, who is a life insurance expert, resident of the Isle of Man, has been working in the life insurance industry and based in the Isle of Man for, I think, at least 25 years, Julian?
Yes, 25.
Can you give me a little bit more about your background before we kick off here?
Yeah, absolutely. So, as I said, I've been here 25 years. I specialise in insurance wrappers for wealthy families. And that's taken me now to working in various jurisdictions. I'm mainly working with private banks, family offices, law firms, wealth managers. And it's an interesting industry in fact that it's evolved a lot. Over 25 years I started in what was a very retail environment, and that's now become an environment which is very bespoke and with solutions matching very particular needs of particular families. So it's been a changeable marketplace for me in that way.
So the market environment has changed quite a lot over the last few years, and there's been quite a lot of consolidation as well, hasn't there?
Yeah, absolutely. I mean, the market, you've had various factors in the market. You've had Brexit and consolidation. They're two, they've had a massive influence on the whole industry. You've gone from when I moved here to the Isle of Man 25 years ago, probably was about 12 providers then that were very active in the UK. Today, in terms of being very active in the UK, it's probably realistically just one provider now, which is, the jury's probably out if that's a good or a bad thing for the industry, but I think people always want more choice.
And why has that happened, do you think? Why has there been such a consolidation?
Well, I've got a theory, but we'll be here a long time. I don't want to bore you with the minutiae. I think a lot of it goes back probably like 20 years ago, the lowering of pricing in insurance contracts, and probably a very short-termist attitude and not really thinking about the future. So a lot of initial pricing came in, which was very unique to the Isle of Man, where the first few years charges would be taken up front, and policies weren't around as long though in those days. There was no RDR; they were probably churned and things like that. And nowadays, policies are obviously sold on a fee basis.
No commission, no initial commission.
Exactly,
or
it's just fees. Yeah, and they last a lot longer now. But there's still a lot around with that low initial pricing, which has meant the businesses aren't as profitable anymore. They're small parts of much larger groups and seen as the riskier part. And they were just offloaded, and they've been swallowed up by a few providers that have then become larger and larger from these consolidated businesses. And those kind of businesses will probably either IPO or be resold again to larger businesses in the future.
Can you tell me a little bit about the life insurance industry and the background of the industry in the Isle of Man? Because it's been long established, I think, hasn't it here?
Yeah, absolutely. Yeah. So the industry in the Isle of Man started around 50 years ago. And it wasn't just we always think of the UK, but those other countries, so Sweden and Denmark, were countries that were catered for from the Isle of Man. And obviously the Isle of Man at that time took on the fact that it could control its own taxation. So these insurance companies could set up here with very little tax on their own profits, and that made it a very attractive jurisdiction. And that became a regulated activity, and the regulator here is very hands-on in terms of insurance regulation, and very helpful and useful to the industry. And that's obviously what set us apart for a long time. And then you've had other jurisdictions pop up, like Luxembourg and Dublin as well.
And those are the three main jurisdictions for life insurance now, are they?
That's right, yeah. Absolutely right. And obviously with Brexit, Dublin and Luxembourg, they cannot be as active now as they once were in the UK. They can work really on a reverse solicitation basis, which is very, very difficult to justify. So Brexit, I wasn't really a fan of it myself. And on the Isle of Man, we couldn't vote for or against anyway.
Right, that's true. Yeah.
But in terms of the Isle of Man and Brexit, for the insurance industry, it's a positive in that we can act as a conduit for European insurers into the UK. We can operate in the UK unhindered, as we're a designated territory. So we don't have to have any extra regulation to go and sell our solutions via intermediaries in the UK.
So providers based in Luxembourg and Ireland are restricted post-Brexit, whereas Isle of Man, no restrictions.
Yeah, they can't market themselves actively in the UK.
Yeah, it's interesting, Julian. Can we go back to basics for a little bit? Why would a high net worth individual or family use a life insurance wrapper?
Yes, it's a great question. And really, there's obviously other vehicles people can use out there. And it's obviously a competitive market. But the reality is that the insurance wrapper provides a massive amount of control. When you speak to families, it's all about control. They want control of their wealth. And that's the bottom line. It's control against it being eroded by taxation. It's control on how and what they invest into. It's control about who has their wealth in the future and how much of it. And those things all come together, and the insurance wrapper can cater for all those issues and give families a lot of control over their wealth. And the fact then is that it's not just, again, the UK, it's all over the world. It's a global tool, and every jurisdiction recognises it and gives you great legislation, which tends to be very beneficial to the holders of insurance wrappers. Whereas if you look at some of the other vehicles, so trusts and offshore corporates, you've had things like the Panama Papers, all sorts of things like this. And those vehicles are obviously compliant in the jurisdiction where they're issued from. But if you're in another country, that doesn't necessarily follow through. Whereas if a family has an insurance wrapper or an insurance contract for its wealth, then you can, it's very black and white. You can tell a family exactly how it's treated and taxed in a particular jurisdiction. And that's also
the certainty there.
Yeah, and there's also the certainty of nearly being able to look into the future, as I call it. The fact with an insurance contract, it's very hard to roll back the rules on existing contracts in a particular jurisdiction. So if you're in a particular jurisdiction with an insurance contract and you've had it for 10 years and a rule changes, it's detrimental to the benefits, you'll actually find that they won't apply to you, and it'll only apply to new contracts. And that's been tested in courts as well. So it's a very robust vehicle. It's very compliant. There's a lot of corporate governance, and you're talking about big and well-regulated insurance companies, and you've got a lot of control there for families. So it's a really useful vehicle for wealthy families.
And why do you think it is, allowed, I suppose, to carry on as it is globally? As you said, many countries, many jurisdictions allow insurance as a way for high net worth individuals and families to plan for the future. Why do you think governments allow that to?
Yeah, great. Again, that's a great question, and it's one I get asked a lot by my clients when I meet them, and they think, "Well, this is great. Why didn't I hear about it before? And how does why is it allowed?" And it's very simple, really, in that the insurance rules that apply to wealthy families apply to everyone. And in fact, the work that we do with families is a tiny, tiny amount of the work that's done in the insurance world. So we all benefit from those common rules. And ultimately, if we take the UK as an example, they want people to fund additionally for their retirement. And that's why we have the thing called the 5% rule, which allows people to take a certain amount of money out.
Oh yeah, talk a bit about that then.
Yeah, so the 5% rule is very peculiar to the UK. No other country has that rule. And it's where you can take 5% of your original capital that you put in the insurance contract every year with no tax or reporting in general. And then if you don't take it, you can roll it up. So it's a great way of taking income in your lifetime and also passing some wealth on to your family in the future. Now, like I said, that's why insurance contracts tend to go on, without having too much government interference, because governments want people to save for the future. And that's why we have these benefits around insurance contracts.
So from a UK perspective, can you just outline what the tax benefits are for a high net worth individual?
Yeah, so in the UK, you're looking at the one we call gross roll-up. That's a phrase we use in the UK, and that's where the investments in the policy, they grow gross, apart from some withholding taxes here and there. So that means things can be traded and sold and bought and just make gains without being any immediate taxation. And then you have the 5% rule, as I just alluded to then, which is really like a return of capital. And then in the future, any money that's taken out over and above the original capital is taxable on the marginal rate of income tax, which obviously people and families can plan around that as well. A lot of the families we work with, they're global families, so they're moving around. They can benefit from certain taxation in certain jurisdictions at certain times. So that's what I was going back to before, is the control.
Yeah.
It gives you a lot of control. Your worst case scenario is that you've deferred tax for a long time.
Yeah,
you
of
know,
course,
anything over that and above that is a bonus.
And when before we started this chat, Julian, we were talking a little bit about something that you called the Great Wealth Transition.
Yep.
Can you go into a little bit more detail about what that is, please?
Yes. Okay. Wish I'd mentioned it now. No, it's again in the insurance world, it's very exciting, but probably not to anybody else. And what that is what we've seen. I think we can see it all around us now. I mean, I have grown-up children, and you know the issue there is that you find that for them to do as well as you've done and to acquire things like property and to have a house, it's a lot more difficult now. And that's because people probably in the age range of 50 and upwards, they're the people that now hold the wealth, because we have it in real estate. We've had it, we went to university and we had grants, there's all these things. So the way wealth is much more concentrated in those higher generations, if you like. And the great wealth transition over the next few years is that wealth, as people pass away, that wealth will need to pass on to the next generation. And obviously you're into billions and billions and billions of this. I've seen figures bandied around. There's quite a few of the banks have done some really good studies, and it's like 30 billion over the next 5 years, or this kind of thing.
The big
That's
figures,
right, yeah. And the exciting thing for the insurance industry in there is that quite a few companies, obviously we can insure people's lives, so it pays them out insurance in that way. But also in terms of the insurance wrappers, the portfolio bonds, what is interesting there is that we have certain things that allow people to plan very well for inheritance tax in the UK, for example, but also in other countries. The insurance contract's very well recognised for succession planning globally. So that's why the insurance industry is very keen to support and work with families in helping them transition their wealth.
So it helps with the wealth transition. What sort of trusts are we thinking of here?
Well, in the UK, you can be looking at discounted gift trusts, flexible reversionary trusts. I think there's going to be a lot more work around those.
What's that? Sorry.
That's a bit like again, I'm banding around this terminology.
No, sure.
See, I find this very exciting.
No, it is.
But yeah, a discounted gift trust for a start is where you basically give away your wealth, but you retain a right to an income.
Yeah, okay.
And
that's not a gift with reservation.
Exactly, and that's the beauty of it. You can give something away, but still take an income, and it's probably the only thing that isn't a gift with reservation in the UK. And they are very suitable for a lot of families. And in the end, the family would inherit an insurance policy at the end of it that's got proceeds in there, which would be taxable. Flexible reversionary trusts, I think, are again a bit more exciting. And that's again where you can give away your money, still keep an income if you need it, but also if it's structured in the right way, you can have the benefits paid out also tax-free to the family in the future as well. And I think that's very exciting for families that really want to do real proper legacy planning and not kind of again, it's all going back to that control. It's all about control. So families want control. So the more control you can give them about their wealth and their future wealth, you're going to be, helping those people a lot more.
Julian, so the UK allows life insurance contracts to be used as a way of helping with succession planning. Are there any other countries in the world that do likewise? Yeah,
probably nearly everywhere else, actually. The UK is quite peculiar because we use trusts and we have some very rules around insurance that are particular to the UK. Once you start venturing off into Europe, a lot of the countries are quite similar, that they allow the proceeds of the insurance policies to be paid out to families as a succession benefit. And that's very common, and that's quite common on a global basis because the contracts are civil contracts, so you can name beneficiaries that will receive the benefits of the policies on the death of the policy holders. So that's a standard practice. If we look at France as a close neighbour, it's very, very normal there for a family to have what they call an insurance V, and to use that to plan the legacy planning and the succession planning of that family, and to have and to use that contract like that. That's a standard normal practice.
Yeah. Okay. Good. So just finally, then, on this subject, Julian. So the investor ultimately owns an insurance contract with an underlying insurance company. What happens if the underlying insurance company goes bust? If it was an Isle of Man insurer, let's say, and it got into financial difficulties, what happens to that policyholder?
for an insurance company to go bust in the Isle of Man, it would take a lot of things to go wrong.
Right.
And that would also be the fact that we're so well regulated, and we have a hands-on regulator that know us, they know us personally, and they can speak to us. They've got good insurance backgrounds, they're very well experienced people. And we have quarterly reporting here, and they can see exactly what an insurance business is doing and how it's running, and take time to meet up with the insurer and say either we're happy with this, how this is going, or we're not very happy with how this is going. So it's a very hands-on regulated environment, and that's pretty common across lots of the insurance jurisdictions, to be honest with you. And so for an insurer to actually go bust, that would have had to fail, and that would be a monumental failure at that point. And even then, when you say go bust, what does that mean? Because the policyholder assets, the assets that are in the policies that belong to the policyholders, the assets are off the balance sheet of the insurance company. We can't use those to fund anything corporately as such. You're then looking at the company going bust would be the fact that we could no longer make a profit from that book of business because because we weren't charging enough, our overheads were too high. And that's it really. And that would mean that at that point, even in reality, before the insurer was going to go bust, the regulator would say, we're going to step in now and we're going to manage this business out. And what would happen then, it would go into runoff. And runoff is where you would get rid of most people, keep your administrators, and keep the book of business going at that point with very limited overheads.
So the underlying assets inside the insurance policy, the assets effectively that the client subscribes in the first place, they are ring fenced.
Exactly.
From the insurance own trading assets is what we're saying here.
That's right. Yeah. Now the Isle of Man, because it used to be a very retail environment in the past, they brought out, I think, really to meet the kind of the needs of advisors internationally, they brought out the Isle of Man Investor Compensation Scheme, which basically says if for whatever reason a policyholder does actually lose money because of an insolvency, they can get up to 90% of the original value of their policy. That's never been used in the Isle of Man to my knowledge. And again, I can't see it ever being used anyway. And that's funded by all the other insurance companies by a levy. But again, that makes the industry watch each other as well, and keeps the regulator very attuned to what we're doing as well. So it's a good question, but it's an extremely remote possibility. And even if it were to happen, then policyholders are exceptionally well protected in that. It's off the corporate balance sheet, and even then, you've also got the Isle of Man Investor Compensation.
So you've got three lines of protection really. You've got the regulator.
Yeah.
The fact's off the corporate balance sheet.
Yes.
And then the investor protection that comes into play as well.
Absolutely, and here on the Isle of Man, the regulator's really looking for a solvency of around 150%. So you've got 50% more. Wealth, if you like, monies to control the assets than you need, if you like. So there's always that headroom as well.
Julian, it's been really good to catch up on insurance and the Isle of Man role in that. Julian Melling, thank you very much.
Thank you, Ken. It's been a pleasure. Thank you very much.
The latest technical content delivered through global conversations with professionals for professionals.